All right, today we're going to do something really important. We're going to distill decades of institutional investment wisdom down into a single usable framework. The goal here is simple, to give you a powerful model for assessing a stock's potential over the next year or so.
But really, it all boils down to just one question. This is it. This is the heart of all serious investment analysis, the one thing that separates the signal from all the noise out there.
And the answer is this. First off, is the company actually generating returns that are higher than what it costs to fund its operations? And second, has the market completely missed that fact or gotten it wrong? Answering those two questions, well, that's the entire game.
So, what we're about to walk through, look, this isn't some brand new theory I just cooked up. This is a synthesis of battle-tested principles for understanding what a business is truly worth. Our entire framework really stands on four key pillars. Think of it like this. First, you've got business quality. Basically, how solid and durable are its profits? Second, value creation. This is the real economic engine. Third, what I call cash flow reality. Is the profit on paper actually turning into cold, hard cash? And finally, valuation logic. This is where we connect the business itself to its stock price.
Now, let's zoom in on the heart of this whole thing, value creation. The concept is actually pretty simple, but it is incredibly powerful. A company only creates value if its return on invested capital, the ROIC, is bigger than its weighted average cost of capital, or WACC. Think about it. If that ROIC is less than the WACC, the business is literally destroying value, no matter what its profit and loss statement says.
Okay, so enough with the theory, right? Let's make this practical. We can actually boil this entire framework down into a quick but really rigorous checklist that pretty much any investor can use. So here they are, 5 questions that just cut right to the chase. Number 1, is the company actually creating value? 2, is its growth making things better or worse? 3, is the profit real? Are the earnings backed up by actual cash? 4, the balance sheet. Is it helping the business or holding it back? And finally, number 5, what story is the market already telling us with the current stock price?
All right, let's really dive in here. Because theory is great, but applying it is where the rubber meets the road. We're going to put a real company, Fludraw, on trial using this exact checklist.
And hey, a really critical point before we jump in. We are only using the data from this specific file. That's intentional. See, in the real world, you never have perfect, complete information. The real skill is being able to reason through what you have, and just as importantly, what you don't. Okay, question 1. And this is, without a doubt, the most important question of all. Is this business's engine running efficiently? Is Fludraw creating or destroying economic value?
All right, so using just the data from our file, we calculate our 2 key metrics. First, we get the return on invested capital. We're looking at the company's operating profit relative to all the capital that's tied up in the business. Then, for the WACC, we're basically blending the cost of the company's debt with the return that shareholders would demand.
And here's the verdict. We take that return on capital and we subtract the cost of that capital. The result is what we call the economic spread. A positive number, that means value creation. A negative one means value destruction. This right here is our first crucial piece of evidence. Once we know the economic spread, it leads us right to our second question. Everyone loves to see growth, right? But is it the right kind of growth? Is it actually making shareholders any wealthier?
So the key here is looking at the combination of growth and that economic spread we just calculated. If the spread is positive, fantastic. Growth is adding value. But if that spread were negative, growth would be actively destroying value. It's like pouring more water into a bucket that's already leaking.
All right, now for our third reality check. A company can report really strong profits, but have terrible cash flow, and that is a classic massive red flag. We have to see if Fludraw's accounting profits are actually translating into real cash. So to figure this out, we start with what's called NOPLAT. That's net operating profit after tax. From there, we add back non-cash charges, like depreciation, and then we adjust for any changes in working capital. This is how we start to bridge that gap between the accounting profit and the actual cash the business is spitting out. But here's where we hit a bit of a wall. Our data file doesn't include capital expenditures, or CapEx, and without that, we just can't calculate a true free cash flow number. As an analyst, you have to be honest about that. You explicitly note this as a key uncertainty, a major risk factor.
Okay, next up, we've got to look at the company's foundation.
Is the balance sheet a source of strength that's going to fuel future growth and investment? Or is it a major constraint, a risk just hanging over the whole business?
And a key metric we use for this is the net debt to EBITDA ratio. It's simple. It tells us how many years of operating earnings it would take for the company to pay back all of its debt. A really high number here suggests a lot more financial risk, and that could seriously limit the company's ability to invest or even just to get through a tough year.
All right, we're at the final question. We've assessed the business itself. Now we have to assess the stock. It's time to figure out what expectations, what story about the future is already baked into today's share price.
You know, a pretty simple way to gauge what the market is thinking is to use a valuation multiple, something like enterprise value to EBITDA. And as you can see here, Fluidra is trading at a premium compared to its peers. So the big question becomes, is that premium justified by the fundamentals we just analyzed?
Okay, now we bring it all together. On one side, we list the cold, hard facts from our analysis, Fluidra's ability to create value, its cash flow situation, its debt level. And on the other side, we translate that valuation multiple into a story. A premium multiple implies that the market expects very high growth and strong profitability to just keep on coming. The whole investment case, the whole opportunity, lives in the gap between these two columns.
So, based on everything we've just done, we can now build a disciplined outlook. We're not just guessing. We have a base case, what's likely to happen if things just continue as they are. Then we have an upside case, what needs to go right for the stock to really outperform. And crucially, the downside case, what are the big risks? This gives us a structured, probabilistic way of looking at the future, not a crystal ball.
And that really brings us to the end. Look, what I want you to walk away with isn't a bunch of formulas. It's a repeatable mental model. To be a successful investor, you have to do three things: understand the raw economics of the business, decode the expectations that are embedded in the stock price, and have the discipline to only act when you see a clear gap between the two. That's the whole game.